A recent survey from Charles Schwab revealed mistakes that investors make, and here now to share more is President and CEO of Wilsey Asset Management, Brent Wilsey. Brent, good morning.
Good morning.
Good to see you
here. Yes.
Okay. We always talk about how investing is counterintuitive.
Correct.
Right. So it's not a feeling thing.
No.
Facts. Okay. You list 3 specific areas here where investors make mistakes.
Yes.
So let's start with the first one. Okay. Greatest investment success is patience through volatility.
Let's talk about this survey too, because it came from Charles Schwab. So these are investors, because I come on, KUSI for nearly 6 years now, and I talk about be patient, don't worry about the volatility. This came from investors with experiences, so everybody can relate to these investors. And this is what they're talking about, the most reasons for successfulness in their investing or the big mistakes they made.
Right.
So the first one is, greatest investment success, patience through volatility. I've said that many times here over the last 6 years. These are investors saying that, and what it means, patience is not 2 or 3 weeks, 2 or 3 months. It could be 2 or 3 years to be patient to get through that. And you're gonna have volatility. I've been doing this for now 40 years. During that 40-year time frame, I've experienced 23 corrections, which is a drop of 10% or more. Investors are saying the same thing I've been saying for 40 years to do this. Now, I also want to let people know about what's called reinvestment risk, because right now, I'm tired of the equities in my 401k going up and down. I'm just gonna go into the money market. I'm going to a CD. That is the worst thing, because there's something called reinvestment risk, where at the end you got to reinvest that money. And what you're missing out, these are the big things. This week, 1 week only, the Dow was up over 5% in 1 week. That's the same you get in that 5% CD for a year. But what you're missing out on is that difference of return. So if you look at getting a 10% return, or 10% to 15%, that's a 50% gain. So a stock goes up 5, that's a 50% gain. But if it just goes to $11 a share, and then to 15, and you miss that $1, who cares? Not a big deal. Well, that brings your return down to 36%, a 14% difference. And you will never make that back up. You can't make that back up. So the further out you go, the worse it becomes. You have that same return going from 10 to 20. Well, now it's 100% return. 11 to 20 is only 82%, about a 20% difference. Now let's put it in dollars for people, because it's very important. $100,000 investment, you're out now $20,000. If you have $1 million 401k IRA, you're now out $200,000. You can never make that up. Do not invest long-term money into short-term things. You'll miss that. That's what the survey talks about. Be patient through volatility.
Okay, good. Next one, careful research or a lack of research.
This happens a lot with people too. And we tell people, before we invest in anything, it's 10, 15, 20 hours of research. It's ongoing as well. People many times just see something on TV like, oh, I'm going to buy XYZ, or I'm going to buy Apple because everybody else made money on Apple. That is not research. Looking at the stock price, watching it go from 10 to 12 or 14, that is not research. What research is understanding that investment, and also taking the time to do that. It takes time. And if you don't do it, then find an advisor who does. But understand what their research is. Don't say, well, I guess they've done well, so I'll do it. Ask them, what is the research you do? Explain it to me. We explain to all our clients the research that we do.
Okay, and the last one, taking on too much risk.
I've seen this unfortunately happen where people get behind the 8 ball. I've only got 10 years, 15 years before I retire. I better take some risk to catch up. Don't do that, because then you can be further behind. And I've seen people unfortunately get to the retirement age where they don't have enough to retire because they took on too much risk. Understand how much risk you're taking. And equities are not risky if you invest in the right ones. They're the best long-term return you can do over 5, 10, 15 years. But don't try to go out and buy the next IPO that's going to come out, initial public offering. Don't try to buy these high-risk cannabis stocks or anything that's overpriced. You're going to destroy your plan. We tell people, if we can average 8, 10, 12% over a 10-year period, we're thrilled with that. That's what you got to do. Don't try to get 15 or 20%. You're gonna lose the money and not get ahead. Okay,
so there you go, everybody. It's right there on your screen. Patience and volatility, research, don't take on too much risk.
Yes, very important. They're very simple rules. I always tell people, it's simple, but it's not easy.
Right.
So it's simple to understand what to do, but not easy to follow those rules sometimes.
How can people get your newsletter?
The best way to get that newsletter, which we talked about this, the whole survey was in the newsletter. Go to our website, smartinvesting2000.com. Again, smartinvesting2000.com. It's free, goes out every Friday at 5 o'clock. they can see it, past ones on our website as well.
All right, Brent Wilsey, Wilsey Asset Management. Thanks, Brent.
You're
Good
welcome.
stuff.